Welcome everyone to today's California Housing Finance Agency's New Opportunities Committee meeting. I am the committee chair, Dr. Fred White, and the first item on the agenda is our roll call. Courtney, could you call the roll?
Yes, Dr. White.
Present.
Is there anyone else in the room with you that is 18 years or older?
No.
Okay. Jim Cervantes?
Present.
Is there anyone else in the room with you that is 18 years or older?
No.
Okay. Maria Cabildo?
I'm here and I am off. My video is off because I'm in New Mexico and the connectivity is not great. And there's no one over 18. Actually, there's nobody here with me.
Excellent, thank you. Undersecretary Grant? Okay. And Tina Johnson Hall? Ms. Johnson Hall, roll call.
I am sorry. I am here and there's no one in the room with me.
Excellent. Chair White, we do have a quorum.
Yes, thank you, Courtney. So the second item on the agenda is the approval of the meeting minutes from our last meeting that took place July 25th. The minutes are in the board package for review. Can I get a motion and second to approve the minutes?
I move approval.
I second.
Okay, thank you. Are there any changes to the minutes that we need to make note of?
I have none.
Okay. Neither do I. I'm hearing no changes. Minutes are approved. We can move forward to item 3. This is the chairperson and executive director comments. I'll start off first. Just would like to thank Chair Cervantes and Executive Director Hall for the honor of serving on this very important committee. And I'd like to thank the staff for just all of your diligent and quick work in terms of assessing and building out methodologies for these potential new opportunities. During our prior meeting, we accomplished a few items, including reviewing, the committee reviewed and discussed the committee charter with the assistance of General Counsel. The committee agreed on the methodology for examining potential new business opportunities. And the committee prioritized a couple of items for the staff to report on for today's meetings. Those are my comments. I'll turn it over to Executive Director Johnson Hall for further comments.
Thank you, Dr. White. I could not say it better than you have. Only wanted to add a thank you for your participation today and stepping up as the committee chair. And also for your idea, which was birthed out of the board meeting back in June. I also want to thank individually each of the board members that are here. I only had one ask when I took on this role, and that was to our committee members, to our board members, to be present, and you have gone above and beyond. So thank you for your vision, sir, and thank you for the committee members for your hard work in helping the staff to bring some of these wonderful ideas to fruition.
Very well said. I appreciate that. We will move on to item 4, which is a review and discussion of an enhanced My Home program concept. Ellen Martin, Director of Home Ownership, will walk us through the methodology for an enhanced My Home program concept.
All right, thank you so much. Good morning, Mr. Chair, members of the committee. My name is Ellen Martin. I'm the Director of Home Ownership, and I'm here today to discuss our first new initiative, which is, as Dr. White said, an enhancement to the existing My Home program. So as you will all recall, My Home is our flagship down payment assistance program that offers up to 3.5% in down payment and closing cost assistance for low and moderate income first-time home buyers. That My Home assistance comes in the form of a silent second mortgage that is due upon resale or refinance at a low fixed interest rate. And the program is funded by our existing Home Purchase Assistance Fund, which was originally capitalized by various sources with the funding recycling over time. So if we could go to the first slide, please. So today's discussion looks at an enhancement to that existing program. And just to set the stage, this relates to our strategic plan goal 1, which centers around increasing our lending impact. Under objective 2, we're looking at expanded single family program opportunities, with initiative 3 directing us to research alternative funding and bond execution strategies that would provide more favorable terms for first-time home buyers. And initiative 4 specifies that we evaluate several potential new product offerings. Next slide, please. So with that as a backdrop, with this program, we are proposing to establish a new program option that would allow borrowers an additional 2.5% in down payment and closing cost assistance that comes in the form of a third lien that would also be repayable at resale or refinance at that same low fixed interest rate. The trade-off for that increased assistance would be a slightly higher first mortgage interest rate on the order of about 50 basis points in today's market. CalHFA would generate the funds for this additional assistance through the issuance of taxable bonds, which would be used to purchase the new third lien as well as the first mortgage. The first mortgages would be securitized, CalHFA would retain the MBS, and the proceeds from that MBS would then be used to repay debt service on the bonds. Next slide, please. So this concept is, of course, at the very earliest of stages, but this slide offers a synopsis of our initial evaluation of the proposal, which is, of course, more fully outlined in your committee packets. In terms of the policy or business objectives, the intent behind this proposal is to offer increased assistance for low and moderate income home buyers in what we know to be a very challenging home buying market. We do know that interest rates are softening and are expected to continue to soften, but home prices remain high, and the recent NAR settlement went into effect last week, which has the potential to significantly increase transaction costs for home buyers. It's also important to note that this program would remediate an existing barrier for buyers of manufactured homes that want to use conventional financing. So currently, those buyers have to bring 5% down in order to access conventional financing. And My Home at its current stage is insufficient to help them make that down payment. We know that many low and moderate income borrowers don't typically have that additional 2% available to put down. So aligning with strategic plan goal 1, objective 2, initiative 4, this product would help us to start to resolve that issue and improve conventional lending options for buyers of manufactured homes. So why CalHFA? This program option would leverage the existing highly successful My Home program, as well as CalHFA's unique ability to issue taxable bonds. So this is a program that we are uniquely capable of rolling out. The program would serve the same population as the existing My Home program, low and moderate income, that's up to 150% AMI, first-time home buyers in California. And just as a reminder, the My Home program has historically performed very well in underrepresented communities. We generally see 60 to 65% of our My Home loans going to communities of color. So this is really an important and proven tool to expand access to sustainable home ownership in BIPOC communities. Implementation would not require any capital outlay on CalHFA's part. The cost of bond issuance would be built into the bond. There will be costs associated with ongoing marketing of the program, but it's not expected that this cost will be a significant margin over what we would incur to market the existing My Home program. Other key benefits of the program are that it diversifies CalHFA sources of revenue and provides an alternative approach to fund the My Home program should we need that in the future. And the next slide goes into a little bit more detail on this front. So under our current model, we pair the My Home down payment assistance loan with a CalHFA first mortgage, which is then securitized and sold on the secondary market. It's the securitization and sale of that first mortgage that's really the cornerstone of our business operations. That's what generates the funds that we need for operating to pay our rent, salaries, keep the lights on. But under that current model, we are generating one-time revenues, and we're reliant on maintaining our production levels every year in order to ensure that we're able to fund those ongoing operations costs. So far, we've been successful in doing so, even in the last couple of tumultuous years in the mortgage market, but we certainly do think that diversification is advisable. So under the proposed taxable bond model, we would purchase and securitize the first mortgages, just like the current model, but we would instead retain that MBS, which would then generate annuity revenue for CalHFA. So over the long term, preliminary estimates suggest that the revenue potential for the taxable bond model is potentially significantly higher on a present value basis, but we do have to account for how this model will impact our annual operating budget. Next slide, please. So there are, of course, any number of risks and other considerations that we will be fully evaluating as we move forward. We have a maximum bond authorization, so we need to ensure that we're monitoring that closely. Our existing funds for My Home do recycle, but that recycling is cyclical. So we need to ensure that any additional demand we might be generating for My Home through this program offering does not overly tax those available My Home funds so that those funds can continue to be available on a perennial basis. That's super important. There are market and borrower risks. If interest rates go down, this product will not be as attractive. So we do need to make sure that we design the program so that we're encouraging rapid uptake relative to the timing of when we issue bonds. We also need to make sure, relatedly, that we maintain robust underwriting criteria because we will be taking a balance sheet risk on that additional 2.5% assistance, so we need to make sure that those loans are repaid. And then there are other various credit and leverage risks that we will need to address to ensure that we maintain our credit rating, and our financing team is already actively engaged with the rating agencies on that front. Next slide, please. So in terms of process and time frame, we have initiated implementation of this program with a target date of January 2025 to be ready for the bond issuance and program availability. This schedule, of course, will require refining as we move into the implementation process, particularly with an eye towards the budget and legislative season. So we will be working with our partners in the administration to refine that timeline as part of program design and implementation. With that, I would be more than happy to take any questions.
Well, thank you, Ellen. I'd like to open up a discussion for the committee members on this item. I'll start first.
Sorry.
Oh, Jim, you have something?
Yeah.
Yep.
I guess first of all, I really love this concept and sort of taking an existing program and augmenting that to reach a broader audience. And I like the notion that we're sort of getting above a trigger where a prospective home buyer could access manufactured housing, because that's kind of what, may be best accessible, especially for people who are in that low to moderate income bracket trying to get in and buy a home. So I think it's really useful to have that sort of flexibility by virtue of this program. I guess what I wanted to maybe talk through, and Chair White, if you can indulge me, is like sort of, I just understand the mechanics a little bit better, because we're selling, the nuance here, I gather, is we're selling taxable bonds to create that additional, what, 2.5% or so. So just talk through that a bit. And then I thought it might be helpful just to, I mean, I appreciate the highlighting of the risks. The memo, I think, did a good job on that, but just to make sure we do right by the board, like talk through each one of those. I mean, that would be kind of something I thought might be helpful, Chair White. So that was what I thought I'd put out there, is just something for us to chew on.
Thanks, Director Cervantes. I agree.
Okay.
All right. Well, so with respect to the mechanics of how the taxable bond issuance will work, I would propose that I'll start with an explanation, and then perhaps my colleague Erwin Tam would be able to chime in with a little bit more detail. So the taxable bond issuance would effectively, the agency would issue taxable bonds that would fund acquisition of the first mortgage and then this new third lien, this new 2.5% third lien. The 3 to 3.5% my home second lien would continue to be funded by HPA funds. Upon the purchase, so we would purchase first mortgages and the third lien using the proceeds of the taxable bond issuance. And then we would securitize those first mortgages into an MBS that is GSE insured. The proceeds of that MBS would be retained to pay debt service on the bonds, plus CalHFA's spread that would provide that source of annuity revenue. So I'll stop there and let Mr. Tam jump in with a little bit more detail about the relationship between the MBS and the bond offering.
Right. And I think Ellen had the correct summary as to, sort of the overall mechanics. We would put the MBS into a, so essentially as collateral for the bond. And then the bonds, we would pay debt service, and CalHFA would capture the incremental spread between the two. One of the important points is, again, since we are generating additional proceeds, it's for the third lien assistance here. We are going to be, it will be a higher rate than, just sort of the on market rate, because we have to capture additional interest to cover that spread there. So the expectation in the current market is it's around 50 basis points. Obviously, it goes without saying, your mileage may vary. And so I think that, but in the current market, the taxable municipal bond market has been relatively strong. And we expect this to be a superior execution than other financing avenues to increase down payment assistance to first-time home buyers.
So understanding that mileage may vary, I've just to put numbers on it, not that we'd hold you to that by any means. So if we thought we could get a taxable rate of X, call it what, 6%? I mean, I don't know where you'd be right now.
Right. We believe it's around 50 bips higher than sort of the on-market rate to achieve the extra 2% or 2.5% DPA assistance.
Right. So it'd be at 6.5 then.
Correct. Essentially. Yeah.
And that covers whatever spread we kind of typically try to make in these deals, and plus the fund the third lien tail on this.
Correct.
Okay. And the part that gets securitized is basically the first mortgage component. So the third lien piece, that extra 2.5 we're putting in is sort of like a kind of a non-asset bond then, or we're funding that through the higher interest rate. I mean, just
exactly. Yeah, exactly. So we would fund right. So the MBS has to throw off enough interest to cover sort of that extra piece there. And I think that's where the secret sauce is in this sort of model.
Okay.
I guess it's not that secret sauce. Will be disclosed within the official statement, so it's not secret to anybody.
Yeah, I don't think we use that in an offer document.
Bad terminology there. There are no secrets in our bond. It will be fully disclosed to our investors.
But it's a neat concept.
Yeah, it is a unique concept. And I think when Erwin was talking about secret sauce, he's talking about these are the types of things that a HFA can do
Right.
that others may not, other types of state agencies may not necessarily be able to do.
Yeah. This strikes me as the kind of stuff we're good at or could be good at. Just out of curiosity, I mean, are there other HFAs out there doing something like this?
Oh, yeah.
I'll let Ellen chime in. I think that in this structure that we're proposing, I think we're fairly unique because we're essentially trying to blend two programs together,
Right.
And be more additive to the current market. Other HFAs do issue taxable bonds and tax exempt bonds to fund their own down payment assistance programs, but we're sort of using that as an overlay on our existing programs. And I think I'm gonna make a wild assumption here, but I think that's relatively unique. Try to build upon our existing programs through this initiative here.
Yeah, I'll chime in there. Erwin's correct. It is other agencies do use taxable bonds to fund DPA. They also use tax exempt bonds to fund DPA. But CalHFA is unique in that we do have a separate source of funding for down payment assistance. So we are not reliant upon taxable or tax exempt bonds to fund our DPA. So that is a unique characteristic of CalHFA that I think provides us a lot more flexibility as the market cycles. We were able to withstand the tumult in the TBA market a lot better than other HFAs that had to pivot very, very quickly away from premium pricing to another model to fund their DPA.
And we're doing a third lien because we really don't, there's other buckets of monies that are generating the second lien. We don't want to mix all
Yeah,
that
so
together.
it'll be two sources of funds to get up to 5.5% to 6% DPA. So we'll have the lien separated so that we can appropriately monitor and report regarding each of those sources.
Okay.
And then Director Cervantes, you requested that we walk through each of the risks associated with the program.
Right, and I think that, again, the memo did a nice job of this. The presentation I think was really clear, but I'm just thinking as we're going to report back to the board, I want to make sure that I feel like, yeah, we really talked through the risks here. And I'm sure that'll be presented to the board as well, but just like to feel like we've done our due diligence, so to speak, on that and make sure we're clear on what the potential downside could be. I just thought that'd be helpful just to carefully walk through that.
Absolutely. Yeah, happy to. So, Mr. Tam, I'll give you a warning that I will hand it over to you about halfway through program risks and to cover the credit risk and leverage section. So we identified 4 key areas of risk: my home sustainability, market risk, program risks, and credit risk and leverage. With regard to my home sustainability, I touched on this, but as I mentioned, my home is currently funded by a separate source of funds in our home purchase assistance account. So those funds sustain the perennial availability of the My Home program. And that is a critical component of the My Home program, is that, the market expectation is that this program is available on an ongoing basis and does not run out of funds. That home purchase assistance fund was originally capitalized by various sources of funding, but the funds recycle as folks pay off their My Home loan. Repayments are cyclical. So we see repayments accelerate when interest rates go down and folks start refinancing at scale. We also see repayments accelerate when the housing market has a lot of churn in it and there's a lot of transactions and people are able to sell their entry-level home and move up, which is, as we all know, is not happening now. So we have to keep a really close eye on that repayment recycling in the My Home fund so that we are able to sustain its long-term operational ability. So one risk that we need to monitor and need to do so through, looking at demand, looking at our repayment streams, creating triggers to adjust eligibility and reducing demand, is that we keep those My Home funds at a level that will permit us to sustain the My Home program perennially. Any questions on that one?
So this is the binding constraint. Is that, do I have that right? This is the second lien component, so to speak, but if you've got, I don't know, 100 million in the till for that, that really defines what you can do with this kind of a program. Is that, do I have that right?
It does, but this program, one ancillary benefit, and ancillary is too soft of a word, a huge benefit of this program is that it diversifies the ways in which we could fund My Home. So if we find that we need to supplement those available My Home funds, this has the infrastructure set up in place such that we have an alternative funding stream in place should we need it.
So just so I understand, so My Home right now, existing My Home Prime is 3.5%. We're on top 2.5%. Theoretically, My Home Prime could be 2.5%, and the third lien gets a little bit bigger to sort of create more available capital here. Is that, do I have that right?
Yeah, theoretically, basically you have more levers to pull and ways to create sort of the stack of down payments. So that is absolutely the idea.
Okay, that's helpful. And certainly with interest rates where they are, repayment rates have just probably plummeted. So
correct.
Yeah. So that's the, yeah, I get it. Okay. Okay.
All right, if there's no further questions, I'll jump into the market risk. So this is a little bit the opposite challenge. So as Mr. Tam mentioned, the first mortgage rate associated with the expanded My Home option will be a notch higher than the existing program. This is absorbable based on where the bond market is relative to mortgage rates. So if mortgage rates come down significantly and we sort of lose that positive economics, then you could see that differential being less favorable. And that's what we're currently experiencing with our ZIP product, which is similar, but fundamentally has seen an enormous drop in demand since mortgage rates went up, because that premium price in order to fund additional closing cost assistance comes at too much of a cost for most borrowers. So they're not willing to pay the higher interest rate to get the additional assistance. So you could see a similar dynamic unfold here if you see the current positive economics relative to the bond market, if you see that change or sort of level out. The mitigant is to design the program carefully and design the sale of bonds carefully so that we have quick uptake relative to the bond issuance. So we want to make sure essentially that we don't get out ahead of our skis and that we have sufficient uptake relative to the timing of that bond issuance that we can maintain the economics that we built into the bonds and the pricing that we set related to that. Erwin, do you have anything to add to that?
I mean, yeah, I think that was a great explanation. I think, just to put a finer point on it, right? Let's say if we go out with $100 million, we set a mortgage rate of 6.5% rates, the market itself falls, we have $100 million of proceeds to which to lend. If the market goes to 550, we're stuck lending at this rate, or we essentially lose revenue for the agency. The question is how to tailor that first issuance, especially it's the most risky at the onset of a program because we don't know what the uptake is. And so how do you structure a program whereby or an issuance whereby we think we're taking some risk but isn't, because obviously it's a new program, there is some general risk involved in terms of the questions as to who's actually going to come through the doors and use our program. And I think that we've sort of settled around $50 million, which is sort of, I believe, plus or minus, which is sort of, I believe, a week of production for the agency. It's actually relatively minimal, but we just want to get our toe in the water, I think, to kind of make sure that we are doing the right things, that the agency is not putting itself at sufficient, substantial financial risks, out of the gates.
Got it. You were getting into something that I wanted you to pull out a little bit more, which is how do we mitigate the risk? What are we doing? How are we looking? What is the lens on that?
Right, and that's on this piece, that would be it, is to limit sort of the first issuance, so we're not, the interest rate risk on on a week of production is what it is, I think, and it's pretty manageable within the agency. There's no other sort of way to, there's no real hedges on uptake in that sense. But I think that it seems reasonable, just based on the sort of the pace as to what Ellen and her team monitor sort of the daily rate locks, and so it seems relatively reasonable for that size. And obviously we can downsize it if just the overall market seems to slow. And then there's always can be, once we get the first issuance done, there's always essentially, if it goes faster than expected, we're going to have a true up on a second bond issuance quickly to follow, right? So because what we're trying to do is kind of create a stability within the program itself. So essentially once you get the first issuance done, every other issuance will be a true up of the prior issuance. So it is, the question is what's the first deal look like to get the ball rolling is sort of the most substantial risk to the agency. In terms of this risk, there are other risks that are involved with, in terms of additional leverage that we can talk about when we get to the fourth one. But I think what Ellen is talking about is most acute in the sort of in the first issuance out the gates.
And just to follow up, I'm sorry, Dr. White, I kind of don't want to cut you off.
Mm-hmm.
Yeah, just following up on Executive Director Hall's comments around how we mitigate these risks. Could we develop a couple of downside scenarios in terms of where we start to mitigate the risk? This conversation sounds like the creation of a forward product. I know it's not a forward product, but it reminds me of my own lending days of just creating a 24-month forward. When you think you're grabbing business, and that's what the forwards were. You're grabbing business that you couldn't get conventionally. But we all know doing a 24-month forward would put us in a situation if rates don't go the way we expect. So if we could do a couple of downside risks around this, I think that would be helpful.
Right. I think we definitely can work on that. This agent, as a lender, CalHFA makes financial promises. On the single family side, we make it in the manner that I believe 60 days essentially in our rate lock. So we sort of have that capability to do so. On the multifamily side, the window's longer. We wait to construction close. So we make lots of financial promises every day as an agency, and we mitigate those via hedges, and other means. So more than happy to sort of write that up for this committee here.
Thank you. Director Cervantes.
Yeah, so it sounds like it's a risk, but one we can sort of manage. Ellen, I think your point about not getting out over our skis. So if you're doing the first tranche and it's at kind of 1 week of our typical pipeline, intuitively, that seems like something you could kind of manage. I'll be honest, 50 million 1 week, it's like, okay, my head sort of snapped at that a bit, but
Yeah.
I get that. And I know that there's a network of agents, lenders, whatever out there you deal with. So it's like getting them prepped on the fact that there's this new product out there that could help a buyer get in. I would think that would incent people to sort of really work it, the program too, I would think.
Yeah, I think you're right on the nose. So on sort of my side of the house, right, it's important that we design the program for uptake. And so that's what Erwin has tasked us with is that we're designing the program for uptake to marry up with the bond issuance and the financial side.
Director Grant, I see your hand.
Hi, can you guys hear me okay?
Yes.
Oh, wonderful. Sorry. I've been holding my breath all meeting. I was just going to say to the discussion, is it fair to say then that it's more of a phased in approach somewhat because you got to kind of start it up, or not phased in the sense of how we're thinking about it. It's just that because you have all the different kind of mitigation strategies based off the chair's comments, it naturally will uptick when it needs to and downsize when it needs to. Just a
Yes.
discussion question.
Yeah, I think that's fair because we, in timing the bond issuances and rolling this out, will be watching the market carefully, and we will be responsive to, current market rates and what we're seeing in terms of demand, and sort of the parameters of the program. So yes, I think that characterization is absolutely fair.
Okay.
Are there any more comments or questions on this agenda item?
Well, I think the program risk and credit risk and leverage are the last two risk items, but
We can run through.
I'm like a dog with a bone on this one, so I'm sorry.
No, it's appreciated. So I'll start with program risks, and then I'll turn things over to Mr. Tam to round out program risks and move into credit risk and leverage. So fundamentally, in terms of program risks, we are lending a borrower more money. And we are lending a borrower more money reliant on the repayment of that first mortgage in order to fund that additional loan amount. So there is certainly a program risk associated with lending borrowers more, right? And relying upon them to pay us that money back. So that's what we've identified as a program risk, with the really essential mitigant of maintaining robust credit and underwriting standards and making sure that we continue to maintain our program parameters that help us to reduce delinquency and default and ensure that our funds get repaid. And I'll turn things over to Erwin now.
Sure. I think you said it right on the program risk side. So I'm going to just quickly discuss credit risks and leverage. I think that I know nobody here is a stranger to the credit process and the credit write-ups on the agency's sort of general financial situation, all of which have been very positive. And the one thing that they've sort of commented on is we're, as an agency over the past decade, we have decreased the overall leverage levels of the agency, right? We have paid off all of our debts. We have not issued bonds. And this will be a reversal of that. But it's also one that we've communicated to them. We've told the credit agencies, as well as the board, that we have $1 billion of multifamily lending to do. And it's already on the books. It's already committed. We're going to issue bonds typically, unless the market changes. We're going to typically issue bonds to finance $1 billion. And that's coming. We've also signaled that on the single family side, we were exploring programs such as this. And they actually viewed it, the initial feedback back has been relatively sort of, measured, right? Is that operationally, this will create a situation where the revenues received by the agency are on an annuity basis. So yes, we will not receive as much money. If you look at year one, right? If you receive all the present value upfront via the securitization model, the TBA model, it will be in excess of the year one revenues received from through this program. But over time, this becomes essentially, I hate to use this term, but apparently it's like passive income, right? It's the idea that we don't actually have to have additional new borrowers within any fiscal year to receive revenue from the activity of the agency. That it creates it is actually more financially stable, assuming that there's a book of business that the agency already has managed. That dovetails into sort of that programmatic risk that Ellen said, right? As long as everything goes well and people are continuing to pay their mortgages, the agency's financial situation would be actually more stable. We don't have, if rates go up, rates go down, we still have our portfolio that we could lean upon. So they actually view that as potentially a credit positive, right? Again, because it is a change from our current situation where 60% of the agency's revenues are just customers coming into the door in any given fiscal year. Did you,
If
sorry, follow up, did you have any further questions on that?
I'm gonna bring up one question around this. It's just around the underwriting standards that you already have in place. Since we're gonna keep this on balance sheet, are we contemplating even more stringent underwriting standards, or we're comfortable where we are now that those standards fit this enhanced program?
At the moment, we're comfortable with where we are now, but we certainly will keep a close eye on that as we move forward into implementation.
Maybe related to that question, this is a backwards looking one, which is what's our current default rate for my home?
Erwin, do you have that at the tip of your fingers, or?
I do not, but I can try to pull it up.
All right,
Okay.
we'll get back to you with that data.
All right.
I will say that I've asked that question as a previous board member, and it is incredibly low.
It is low.
It is incredibly low. We'll get the exact numbers, but this is something that I used to monitor in my past life. And I would often ask that question. And I was really quite surprised on two things as it relates to our My Home portfolio. Number one was the percentage of defaults, which was just incredibly low. It was shockingly low, especially if you look at this through the lens of the percentage of borrowers that we provide loans to who are at or below 80% AMI. So it's a significant number. The other thing that was significant about our portfolio is our demographics, which if you compare that to conventional lenders, looks like night and day. It's almost as if we're in a space that we're on the moon and they are on Earth. I mean, it's just that radically different, but it's a good thing for us to talk about and to share, because it actually will help to educate folks about both the AMI borrowers that we lend into, as well as the demographics. It busts a lot of myths. And so what I would ask as a follow-up, and when we bring this, is that we're able to share that about My Home. I think it's worth repeating again and again.
Absolutely.
I mean, thank you all for answering my questions. I mean, I really have to say, I'm frankly really excited by this. Just to put my cards on the table, it's like, I think this is a vehicle to help lower income communities of color access the American middle class. And they want to, down the line, they refinance their homes in 5-7 years or whatever. That's great. We got them in. And I think that's kind of what, CalHFA can do here to open the door of opportunity for people. So I think it's creative. I think, Dr. Wright, I want to get out of my skis on this, but I mean, I don't know what the process is for us. I mean, to recommend this at the next board meeting. I'm not sure what the ask is, but I think I will defer to our committee chair here on what we want to do with this.
We hope to bring this forward to the board to advance it as a product at the September board meeting.
Yeah. I'm all in. That's great.
I just wanted to echo the chair's comments as well. We're very enthusiastic about just the prospects and the potential of this. I think this coming from the first committee meeting when we were just kind of hearing about the concept, and to just now just see it as a full-blown proposal. And I actually really appreciate the simplicity of it. Even though we're talking about the complexities of it on the back end, it's actually quite simple of like, before you could have this much, but now you could have this much. And just, we all know like just the level of opportunities it provides. So just wanted to just echo Mr. Cervantes' comments, that just really excited about the opportunity coming out of the opportunity committee for its first referral to the board.
Thank you, Madam Undersecretary. I want to also emphasize that my direction for the staff here was, let's look and see how we can use, you're going to hear me say it over and over again, our secret sauce. What can we do to make a to fill a gap, something that's missing in the market. This is something where we're using our existing program, looking internally at that and saying, how can we make it better? And this is what this team has done. So I am incredibly proud of them. Just sort of, it could have been really easy to rest on our laurels here because my home works wonderfully in the market, as I've mentioned. Very low default rate, demographics are great. A lot of people are getting into homes, but how can we make it better? We're looking at low-hanging fruit like this in order to meet the demands that the secretary mentioned that was important to the governor.
Yep.
How do we get more people into a home? And so with that lens, I'm challenging my team to look even deeper at this. How do we do this? And how do we do it quickly? And this is what this program, to me, exhibits. We can do this. We could do this quickly. We're not going to ask anyone for more money to do it. We're going to look at our own resources and see how we can move people into a home. And so to my staff, I say, well done. Thank you.
Yeah.
Thank you. I'll put an exclamation point around all of those comments as we close the discussion on this agenda item. As we think about presenting this particular item to the board, I would suggest that you lead with how well my home is now, and how you are not changing it, you're expanding it, you're enhancing it, you're not doing anything to it. You've just you're enhancing it, and lead with just how well it's performed over the years, and you know, include that very low default rate as well, as we advance it. So with that said, if there aren't any more comments.
I do have a question for the chair here. Is it the sense of the chair and the committee that that we should proceed with all documentation required to execute such a program? Because if so, there are logistical changes and we need to make to our existing financing resolutions, the same ones I presented in March of this year, which take effect for this fiscal year, to allow us to actually issue bonds for this purpose, right? Our existing bonds only, our existing resolutions do not actually cover the additional the additional sort of down payment assistance piece of it. And we would need to seek amendments to the existing financing resolutions to accomplish that.
So I'm gonna jump out on that answer really quick, and Executive Director Johnson Hall jump in here. I think you need to, if we feel pretty good about this, we want to advance this, you need the infrastructure to do it. So you have to ask for everything.
Okay.
So that's my answer.
And I'd agree with that. It's like, obviously the board needs to sign off, but it's sort of like the follow on to that kind of discussion, I would think would be approval of the amendments to the resolution, just to make it happen. As opposed to waiting yet another meeting.
Yeah,
like, just go for it. That'd be my attitude.
Okay.
I just wanted to confirm that, you know, that was the sense of this committee before we attempt to agendize, you know, amendments.
Okay. That's going to be a as we talk about other new opportunity items, that's going to be a standing answer for me on that we put this all on the table. Any other questions on this agenda item? Okay, if there's no more discussion, I'll open it up for public comment. Courtney, could you check to see if there's any public comment?
Yes, if any members of the public would like to make a comment, please use the raise hand function and we will unmute your mic so you can make your comment. And Chair White, I'm not seeing any hands up.
Okay, we can wrap up the discussion here and move forward to item 5, which is Ellen. She's going to review an employer-based shared appreciation program concept.
All right. Well, thank you. So as Chair White said, moving to our employer-based shared appreciation program concept. If we could go to the first slide, please. So again, this initiative, just to set the stage, is directly aligned with our strategic plan goal 1, objective 2, this time with initiative 6, specifically directing us to explore potential shared appreciation loan product iterations and partnerships. So if we could go to the next slide, please. With that in mind, we have been engaged in discussions with a major employer in California that is interested in funding a pilot program where their employees have access to a down payment assistance program that's modeled on the Dream for All Shared Appreciation Loan Program. So the employer would provide the funding for the shared appreciation loan, which would then be paired with a CalHFA first mortgage, and CalHFA would set up and administer the loan program. Next slide, please. So as I mentioned, we have been engaged with discussions with this partner for several months, which provides the basis for our program concept and evaluation that we've set forth in your committee packets and that I will summarize here. In terms of our policy and business objectives, this program would help a major California employer to meet their workforce attraction and retention goals, while also providing alternative capital to fund a shared appreciation loan program, which, as we all know, has proven to be a powerful tool in CalHFA's mission to provide access to homeownership for more Californians. Again, why CalHFA? Over the last 2 years, CalHFA has committed significant staff resources to developing the program infrastructure and staff expertise needed to administer a shared appreciation loan program. We all know that a shared appreciation loan is a very complex loan product, and currently that expertise and infrastructure simply does not exist in the government or private sector. Our investment would be limited to the staff time required to administer the program, which would be covered by CalHFA's negotiated administration fees and revenues associated with the first mortgage securitization. Other benefits include diversifying CalHFA's revenue sources and maintaining the Dream for All expertise and infrastructure should additional funds for that program be available in the future. Next slide, please. So as we implement this program, we need to acknowledge that initially it would be fairly small, but if successful, there are certainly opportunities to scale. We would have a long-term obligation to service these loans, which would be built into our negotiated administrative fee consideration. And then finally, as with any partnership, it's of course critical that we choose our partners wisely in order to ensure that we are maintaining CalHFA's reputation as well as clarity regarding our agency mission. So all of these items will be carefully considered as part of an MOU with our potential funding partner, which is currently under negotiation. We hope to have that MOU executed by the end of the calendar year, at which time we would proceed with program implementation. And with that, again, I'm happy to answer any questions.
Thank you, Ellen. I'd like to open this item up for discussion for committee members.
Chair White, I think I want to go back to, like, again, risks.
Yeah.
I see a risk. There's a risk of staff time. If there's a lot of time and effort spent and nothing happens, then obviously that's a loss. But financially, it doesn't seem like there's a risk here at CalHFA. I just want to make sure I understand, see if there's anything I'm missing.
I don't think so. I think the risks have to do, they're sort of the same risks as the Dream for All program, right? The risks have to do with the fact that this is a long-term engagement with a borrower who has a complex shared appreciation loan product that we will need to make sure they understand on, not just when they take the loan out, but every year thereafter until such time as they repay us. So there's sort of, a long-term I don't know if I would characterize it as a servicing risk, but there's a long-term servicing relationship that is attendant with any shared appreciation loan product. And so that's something that we need to be very careful to and very diligent about making sure that folks understand this loan and understand both their rights and responsibilities and obligations under this very complex loan product. So I think that's, but you're correct, you know, similar to Dream for All, the funds would be the funds to fund the shared appreciation loan amount would not come from CalHFA. They would be funded by the employer. And so the associated, you know, initial capital risk is outside CalHFA.
So like in Dream for All, if there's a market downturn, instead of appreciation, it's depreciation of that home, and there's a loss of, I don't know, X% here, it's the party that put in the funds that really is at risk for that, I would think.
That's correct. And so that's the biggest challenge. Of course, you know, it's really, if there's depreciation, so there's no appreciation to capture, then the appreciation share is 0. But if we get the full principal amount back, then that should, by definition, still be enough to recycle and help the next homeowner, even in a downward market. But that is, of course, contingent upon the initial principal amount coming back in to the program coffers.
Right. Okay. Thank you.
I see Director Cabildo's hand.
I have a question. It's more of a curiosity. Since the employer is providing the capital for the loan, I imagine that we're having to work out if the employee stops being employed by the employer, if there's not a risk of our having to then kind of recapture a loan when the employee leaves, right? That's all the risk that the employer is taking on, correct? And I'm just curious, I imagine that's part of the negotiation, right? Is it?
Yeah, that will be part of discussions regarding program eligibility and repayment triggers. If, say, hypothetically, the employer leaves the employee of the funding party, they would still have this lien with us. So even if they're no longer employed by this entity, the lien would still be due and would flow when repaid, would flow back into the program to be available for future employees of this employer.
Yeah, I'm wondering, Claire, would you also weigh in on this as our general counsel?
I'd be happy to, Director Johnson Hall. Although maybe is there a specific concern that you wanted me to highlight?
Well, it sounded as if Director Cabildo was wondering about sort of the legal lens on this.
Just curious, like, we're not going to be in a position where the employer wants to recapture the shared appreciation loan because the employee is no longer employed with them.
So that's correct, Director Cabildo. The employer would not be in a position to compel immediate repayment if the employee leaves the employ of the funder. There's no discussion or even honestly good reason to do that as far as I can tell. So no, there would be no legal compelling factor from the employer to the employee that he or she has to pay the loan upon leaving. In fact, I think just theoretically, a person may be working for the employer, receive the loan, stay with the employer for 5 years, and then find that she's been offered a terrific opportunity with a different employer. CalHFA is still achieving the goals with which we are, setting out, which is to create new homeowners and help people with upward mobility. Does that answer the question, or have I missed the mark there?
No, that definitely does. And I know that, as part of our mission and goals, it's important for us to also serve and reach, populations that have not traditionally benefited from home ownership. Do we have the capacity to also encourage that type of diversity when we're entering into a partnership with an employer that'll be providing capital, or is it something that's more of a we'd encourage, but there's no way to create a mandate around?
So I'll start and then perhaps council can also chime in. I think it is certainly important as we enter into any partnership with an external entity that we make sure that the agreements are fully structured to reflect CalHFA's mission, vision, and standards, right? So that's pretty sacrosanct in terms of the agreement that we enter into with any partner. That said, as a public sector entity, any partners that we engage with this may be subject to the same limitations that we are subject to in terms of Prop 209 and the inability to target funds to specific populations. But we can certainly encourage, as part of furthering our mission, vision, and standards, that the entity market and outreach to the communities that we are targeting.
Okay, I understand. I understand, and I understand the limitations. I know that we've done things, I don't remember which program it was, right, in terms of we went so far as to, you know, target for first-time home buyers, but so this isn't necessarily something that would be for first-time home buyers either, right?
That would be a point of an eligibility point that would be the topic of discussion with the employer.
Okay. All right. Well, this is great. I guess I am understanding this is really about a goal of increasing home ownership, but it may not have, we wouldn't have the capacity to do things like we did in the last program, where I think we even asked that like people's parents hadn't been homeowners before, right? So we wouldn't be able to do those type of things to encourage home ownership on the part of people, households that have previously not had access to like multi-generational wealth, right?
Yeah, I think you're correct that any eligibility parameters would be more a subject of negotiation with the funding partner and would have to give due consideration to their workforce attraction and retention goals, as well as our own policy goals. But Dream for All is certainly providing the model for this program. And I think those considerations will absolutely be part of any discussion.
Thank you very much.
Director Grant.
Thank you. You know, my questions were actually right along the lines of Director Cabildo, because I was thinking about the employer as well. And the first thing I thought about was not wanting the employer to look or feel like the landlord, right? Is that at the end of the day, that as we are assessing the partnership with the employer, is they're obviously, they love CalHFA, but I appreciate what you said, Ellen, that we're also assessing, you know, them as well, right? The ability for that partnership to still flourish and for it not to be taken outside of the mission of what we're intending to do in this committee. So all the questions I had actually just got answered in the last 5 minutes. But more so just that emphasis of the relationship and the variability of what works and what doesn't. And it just sounds like, because this is more pilot style, it feels like, and more case by case scenario, that, you know, we just be trying to take the best opportunity to see if it really can lend as much, you know, access to home ownership, especially for employers who are trying to recruit employees in, but there's no place for those employees to stay or live because it's just too doggone expensive. So they can't get gainfully employed without driving 100 miles out. Anyway, I know I'm preaching to the choir. Yes, very interested in learning more, and no further questions at this time.
Thank you.
So my comment, and I spoke to Ellen in a pre-meeting here, is around that MOU. I think that MOU is going to be where everything is, and it needs to be pretty robust, which I know everyone has that assignment, and that's what's going to happen. And it has to translate into another agreement. Are we just working with the MOU, the memorandum of understanding, and then going into like a more solid agreement? That's a question. I'm not sure if it's just.
Yeah, so my answer to that is yes, we're starting with an MOU and then there would be a funding agreement, but I'm looking at Claire to see if I got that right.
Sorry, I don't know why it takes me so long to unmute. My cursor seems to jump back and forth between multiple screens and I can never find the darn thing. Yes, Ms. Martin and Director White, we would first finish the negotiation of the MOU, and then after that, there would be a supplemental funding agreement between the parties with a very high degree of specificity and clarity, if all goes well.
Okay, thank you.
Mr. Chair.
Yeah.
Oh, I'm sorry.
Go ahead.
I would just thinking about this is that, is there any type of standard or criteria for the ideal employer that we would partnership with? Like, are we looking for an employer that's been, in business for 50 plus years, or that has X, not recruitment, but what you could say retention rates, and not that we would go into that level of specificity, but I was just thinking about, what Mr. Cervantes said prior in the prior discussion in the other agenda item, when we go before the board, just wondering to what extent have we thought about those type of things? And maybe it's just a discussion for the committee, but just wanted to bring that up as well. Like, have we thought about those type of things when we're looking at who's the ideal employer to partner with on this?
So not at that level of specificity, but I think in terms of broad strokes, absolutely. We certainly want to make sure that any employer partner that we engage with fundamentally has goals for this program that align with our own mission. I think that's most important. I think we also want to ensure that any employer that we work with is targeting, to Director Cabildo's points, is targeting a population that we also target and statutorily can provide assistance to, right? So those are, I would say, really fundamental cornerstones. As of thus far, our engagement has been fairly opportunistic, but I really appreciate the question, because I think as we work to scale the program, that's going to be, and I think was so well highlighted in the risks outlined here by our enterprise risk management department, is that partner selection is really critical to making sure that this program not only meets workforce retention and attraction goals, but also helps to further the agency mission of serving low and moderate first-time other home buyers that we want to help in California. So I really appreciate the question. And I think that's something that we will really dig into as we see the opportunities for scale with this program.
And if I might add, thank you, Ellen. I think you did a wonderful job of explaining that. I would just remind the committee, we still are a part of the state system. So the state has in fact outlined who we can and cannot do business. Let's go back and hearken to those state guidelines as a start, to make sure that we are in bounds, and with what the state would consider acceptable and not acceptable, as a start. And so thank you, Undersecretary Grant, and also Committee Member Cabildo. I think we understand the assignment, which is that there are some nuances with the work that we do that we want to make sure carry through and flow through with this product, because we are sort of entering into the market, a different type of market of customers. And so there are sensitivities there that we need to make sure that we are in alignment with.
there is Director Cervantes.
Sorry about that. I'm kind of moving on to a question of more process, which is, thank you. My few risk questions you've kind of answered here. MOU sort of like in the works, but I guess then, so this is for Chair White. I would think we would want to uplift this at the next board meeting, assuming the committee is all on board with this concept. So the board is aware that we're recommending something and that there's work on an MOU. It's going to come back to the board, I would think. Or just some of the mechanics would be something I kind of just want to understand, like what the next steps would be on all this.
To your point, from this committee, we are going to advance this to the board for next month's meeting. And I'll let the staff, I'll let Executive Director Hall answer the actual logistics and mechanics, what's going to be presented. The MOU, we are already talking to this potential partner in terms of an MOU. I think that's going to be a part of the advancement discussion. And I'm going to leave it there. And I'll let the staff kind of jump in.
I think I see Claire coming off mute, so I think I will defer to her. Okay. Well, Claire, if I might, if you could indulge in terms of helping to relay, the MOU, funding agreement, board approvals, I think that would be helpful.
Sure. Okay. So, Director White, if I may, I think that we have two choices here. Typically speaking, on any new program launch, and this is not necessarily a new program, it's kind of like adjacent to an existing program, we would bring a resolution back to the board for their full approval. The other alternative is if we feel as though that's immature, not immature, premature. What we may want to do is just ask Dr. White to give a report out to the board about the discussions that are ongoing, about the concept, and then at a later time, if we have a fully executed MOU and more specifics about the program, then maybe request that resolution from the board of directors, full board.
That sounds great. What I would suggest, and it's jumping into the next item, the other matters, this may come up in that agenda item in terms of other matters. And I like the idea of a report out to the board versus just dropping an MOU on the board resolution next month. But Executive Director Hall, let me know if that's where you and staff are prepared and ready to proceed in terms of just going straight to a resolution and an MOU versus reporting out on it at the next board meeting. And this is something that we could jump into in agenda item 6. If there are no more discussions or comments on agenda item 5, we can go to 6, but I'll stop there.
If I could just chime in on 5 with your indulgence, just to say, I think this is great. I mean, just to be upfront, in that it keeps the dream alive with that program. And I think that I mean, the original concept, as I recall, as the Treasurer's Office worked through, was $1 billion a year out of state funds. Well, that's not happening.
Mhm.
And so if we can keep the mechanics working so it doesn't get rusty, and this becomes a pilot, it's a pilot, but maybe if successful, other employers in California may see this as a tool to keep their workforce here, which to me would be more than consistent with, I think the governor's direction would be that we maintain a vital, vibrant California economy, attracting the best talent we can and keeping them across the spectrum. So I think it's exciting, and thank God that there's some employer out there who's interested in doing this. hopefully there could be more down the line. But, you know, I just want to say it's, I think this is just a great combination of factors that maybe hopefully leads to something that could be meaningful for California.
Thank you.
Thank you. And if I might add, I know we still need to get to public comment on this one,
Yeah.
but one thing that I want to reserve an ability to connect with Dr. White on this one, with the committee's buy-in on that. That would be helpful. I do think that the one thing that I like about this is sort of the same thing that I mentioned on the first opportunity, was this is an elevation of an existing program. And so but it does cast some nuances that I still want to check in with my team on. And so if you will just, you know, give me a little bit of room to check some things here, then I can better discuss next steps.
Thank you, Director Hall. So if there aren't any more discussion on item 5, we can open this up for public comment. Courtney, could you check to see if there's public comment?
If any members of the public would like to make a comment, please raise your hand using the raise hand function at the bottom of your screen, and we will unmute your mic. I am not seeing any hands.
Thanks, Courtney. We can wrap up this discussion for agenda 5 and move on to item 6, which is other committee matters. Are there any other committee matters that members wish to raise for today's call? Director Cervantes.
Yes, thank you, Chair White. There were other concepts we talked about in the prior meeting, and I don't want to, I mean, not agendized here, but I like the workforce housing / middle income housing concept, which we're not talking about here. I gather the time is not quite ripe for that, but I just want to make sure that the other concepts we talked about are still in play, maybe for a subsequent meeting. I just thought I'd throw that out there to see where that might land.
Understood. I had a similar comment for matters, and I want to raise the potential of having another meeting before our board meeting in September to address a couple of other matters. One that you just named, Director Cervantes. You know, adding the I know this Executive Director Hall and the staff are working on readying a presentation regarding the middle income concept, and so I think they are close to that. Correct me if I'm wrong, Erwin, but I think they're close to that, and they would be prepared to present methodology on the middle income concept at a subcommittee meeting before September 26th.
Yes, I think we're continuing to work on that concept in anticipation of, you know, and under the direction of this committee. So I think to the extent there is a desire for the board to meet, this committee to meet prior to the board, we can keep you as chair informed as to sort of the timing of that. I'm not sure what the availability of the other members, but you know, that is we are working hard towards that target.
Okay. Director Cabildo, I see your hand.
Director White, I just, you mentioned September 26th. On the calendar, I have that our meeting is on the 19th. Which day is it? Because I'm unable to attend on the 26th, so I just want to confirm, since you said the time.
Okay, actually, could staff confirm the next September?
The next meeting is scheduled for Thursday, September 19th.
It's the 19th. Okay, so that does squeeze the timing up somewhat in terms of a potential subcommittee meeting before that date. Thank you, Director Cabildo. Is there enough time to actually have those materials prepared in advance of that 19th date for a subcommittee meeting?
Yeah, I believe so. You know, obviously there's still some additional items to iron out, but we can schedule a meeting, you know, at the chair's discretion. And you know, we will keep you updated as to sort of the progress we're making.
Okay, so I'm thank you, Erwin. I would propose then for that for a potential subcommittee meeting, it would be the week of September 9th, I believe. And I want to make sure that that timing works in terms of the cutoff for materials needing to be ready. So if staff could look at the dates, it seems like September 9th, the week of September 9th is potential week for the meeting.
Wanna make, I have a commitment on the 12th, so if we have a meeting on that Thursday, I will not be able to attend unless it's in the afternoon, like at 4 o'clock.
Okay. Thank you, Director Cabildo.
And for my part, there's a few things going on, but I'll work to make myself available, especially if we do this by Zoom, it helps. Don't have to do it on a Thursday necessarily from my perspective, but I think it'd be great if we could get that off the ground too.
Okay. And I'll add to just this middle income item is what we're discussing here in item the agenda item 6 for other matters. The item number 5 may be a part of this next discussion as well. I just want to keep that open.
Sounds good. Sounds good.
So we'll figure out a date for this next subcommittee meeting. We should have that figured out fairly soon, and we can get the date out to the committee. Is there any other discussion on item 6, other matters that we should bring to the table? No. Okay, I will ask Courtney to check for any public comment. Agenda item 7.
Absolutely. If any members of the public would like to make a comment, please raise your hand using the raised hand feature. And I'm not seeing any hands.
Okay, thanks, Courtney. This is the end of our second meeting. I appreciate everyone's time and input. And we are adjourned.